Are you tired of playing the stock market casino and losing big? Want to invest smarter, not harder? Then you need to listen up, because today we're going to reveal the ultimate hack to diversifying your investments and minimizing your risk, all with the help of ETF. But before we get started, don't forget to hit that like button and subscribe to our channel for more insider tips and tricks on how to make your money work harder for you. Investing in the stock market may provide excitement and possibly financial benefit, but it is important to understand that all investments have inherent dangers. A few things are guaranteed when handling your finances and navigating the stock market. However, reputable investing columns will always highlight the necessity of knowing and managing risk, and diversification is often recommended as a crucial technique to limit possible losses. By diversifying your portfolio across several assets and sectors, you can protect your investments from market volatility and reduce your exposure to any one area. Diversify or die. Why you need to protect your investments. Diversification is essential for lowering risks and building a strong investing portfolio. ETFs have evolved as an effective tool for investor diversification. Let's look at how you can utilize ETF to successfully diversify your portfolio. The basics of building a well-balanced portfolio. Asset allocation, which entails distributing your assets across multiple asset classes, such as equities, bonds, and cash, is one of the fundamental purposes of creating a portfolio. The best asset allocation for a certain investor is determined by their objectives, risk tolerance, and investment horizon. A younger investor, for example, with a longer investing horizon and a greater risk tolerance, may decide to allocate a higher amount of their portfolio to stocks. Bonds may be a better option for older individuals with a shorter investment horizon and lower risk tolerance. The result is that balanced portfolios should include broad asset classes, but even within a balanced portfolio, there is room for flexibility based on the circumstances of individual investors. ETFs are a popular investment tool for diversification since they expose investors to various markets and asset types in tidy predefined packaging. Like mutual funds, ETF aggregate investors' money and invest it in a portfolio of assets. However, unlike mutual funds, they are traded on stock exchanges as individual equities. The decreased expenses of ETF versus mutual funds are a big benefit. Compared to mutual funds, ETF often have lower expense ratios and do not carry sales charges, making them the more cost-effective alternative for attaining simple diversification. Another advantage for those investors seeking stability will like the fact that ETF may be traded throughout the day, making them more liquid and simpler to trade than mutual funds. Options for investing in ETFs. ETFs are a popular investing instrument that can help with portfolio diversification. They are classified as equities, fixed income, commodity, and currency ETF. Equity ETF allow investors to get exposure to a certain market sector, such as large cap equities, small cap companies, or sector-specific stocks. ETF may be actively or passively managed. Actively managed ETF are managed by a professional fund manager who actively chooses assets intending to outperform the market. Passively managed ETFs monitor a certain index or market and seek to replicate its performance. Fixed income ETF invest in a bond portfolio, providing exposure to various bond markets and maturities. Oil and gold are examples of genuine commodities invested in commodity ETFs, while currency ETFs invest in currencies and provide exposure to the currency. When selecting ETFs for a broad portfolio, investors should consider cost ratios, liquidity, and trade volume. Furthermore, investors should confirm that the ETF matches their investing objectives, risk tolerance, and investment horizon. Building a diverse ETF portfolio. Building a diversified ETF portfolio is a wonderful approach for savvy investors to achieve long-term gain while minimizing risk. The exposure to any specific investment may be reduced while potential returns may increase by investing in a wide portfolio of assets. The critical goal is to recognize that not all investments succeed. Therefore, diversifying your portfolio allows you to hedge your chances across multiple market segments. The oft-quoted 80-20 rule of investment also impacts this way of thinking. Many investors will use the 80-20 rule to manage their portfolios, which states that 20% of a portfolio's assets drive 80% of its performance. In other words, 80% of a portfolio's risk originates from 20% of its assets, emphasizing the significance of diversification and risk management. Here are 3 easy steps to building a diverse ETF portfolio. Number 1. Determine your asset allocation. Your asset allocation should be based on your long-term objectives, risk tolerance, and time horizon. A long-term investor's usual distribution may be 60% equities and 40% bonds. Speaking with a competent advisor will assist you in delving further into these assessments. Number 2. Select the right ETFs. It is critical to establish a diverse portfolio by selecting the best ETFs, depending on your asset allocation. Look for ETFs that follow broad indexes or particular industries or areas that correspond to your investing objectives. It is also critical to analyze the expense ratio, liquidity, and trading volume of the ETF. Number 3. Rebalance the portfolio over time. Rebalancing your portfolio entails returning your asset allocation to its original goals regularly. This guarantees that your portfolio constantly aligns with your investing objectives and that diversity is maintained throughout time. A balanced ETF portfolio might vary from one investor to the next. Here's an example of what this may look like. A conservative portfolio may consist of 60% bond ETFs and 40% stock ETFs weighted to the NASDAQ Top 100. A moderate portfolio may consist of 40% bond ETFs, 50% stock ETFs, and 10% alternative asset ETF. An aggressive strategy would include 70% equity ETFs, like the S&P 500, and 30% other asset ETFs, like sustainable investing. Lastly, investors contemplating investing in ETF should investigate and obtain financial counsel. ETFs are complex financial instruments susceptible to market fluctuations and other risks. Investors may better understand the risks and benefits of investing in ETF and make more educated choices about their investment plans by completing extensive research and consulting with financial professionals. Thanks for watching. We hope you found this video on investing in ETFs helpful in diversifying your portfolio and minimizing your risk. But don't stop here. There's so much more to learn when it comes to personal finance and investing. Be sure to check out our other videos for more insider tips and tricks on how to make your money work harder for you. And if you have any questions or suggestions for future videos, let us know in the comments below. Remember, the key to financial success is knowledge, so keep learning and stay tuned for more great content.